really love doing here at Movement is being proactive with our condominium deals here, as we're all well aware when you have a condominium property, not only does the buyer have to be approved, but the condo has to be approved. So we like being proactive, and we've got tools for both sides of the deal, buyer and seller. For the buyer's agent, Movement Mortgage has something called Condo Pre-Submit. When you have a client looking to purchase a condominium and they haven't put in an offer or they're looking at a couple, our LOs can take their application and then utilize our Condo Pre-Submit process where we request docs up front the fee for the cost of the docs, and we review for that program type the client is looking for. If the project is approved, then you're able to put in offers with that condo approval, which makes it that much more of a stronger and competitive offer. The important thing I want to emphasize about condo pre-submit is that if the project isn't eligible, the agent nor the clients are paying for that condo review. Movement eats that fee. We want them to feel comfortable to continue shopping and find a condominium project that is eligible for the program and financing type that they are looking for. So again, that's condo pre-submit, and that is a tool for the buyer's agents and those buyers to get a project reviewed up front prior to even going under contract, or being proactive. If an offer was just put in and we think it's going to get accepted, we can start that process immediately through condo pre-submit. Now, for the listing agent side, we like to kind of drop some knowledge. Knowledge is power, right? Empower your sellers. The sellers being a current owner within the condominium, they already have access to a majority of the documentation that lenders are going to need to review. You can request it from the seller, send it up to your Movement Mortgage loan officer, and they'll send it to our condo department here, where we will get it reviewed to let you know of any potential issues, red flags, etc. To name some of those documents that seller is going to have readily available to them: the budget, the master insurance, any notices that went out about special assessments, litigation, a lot of the stuff that would also be readily available in a seller resale package. So again, empowering that seller to get you what you need up front and over to a Movement Mortgage loan officer, you're able to get a majority of the condominium reviewed before you even list. Furthermore, what a seller could do if you want to take it to the next level is ask the management company for the most recent questionnaire that they completed for any other lender. We'll also review that, and then we'd have a questionnaire, budget, and insurance. And that right there, 9 times out of 10, is a majority of what any lender is going to need to review a condominium. And you'll have a complete decisioning on the project before you even list, and you guys can co-market on those listings to ensure financing eligibility. So we've got condo pre-submit for the buyer's agents, and just a little bit of knowledge and empowering the seller from the listing agent standpoint, so we can get docs reviewed before you even list. Now, at this point, are there any questions about condo pre-submit or what you can get the seller to obtain?
I have one.
What you got?
So Ian, let's say the buyer is looking at a ton of different condos and you do all these reviews up front. Or is it a cumulative fee or just for the actual project they go into contract on?
It would be just for the condo they go under contract on.
Okay.
Ian? Mona had a question. It says, are you requesting the resale cert ahead of time, or is it different information? And can we have a copy of the deck at the end of the meeting?
Yeah, absolutely. So the resale package and the resale cert is different documentation from the lender requirements. Like a resale cert is not a lender questionnaire. That doesn't mean that the resale package isn't going to overlap some of the documentation that lenders are going to need for conventional FHA or VA financing. Great question. But we do not typically utilize a resale certificate in lieu of a questionnaire. And the reason being is a lot of the times that resale certificate more so speaks to that one specific unit within the entire project and only touches on a couple of points on the condominium as a whole, like litigation and special assessments. So, kind of going back to that with what the seller can get us, by law, these HOA boards are required to provide all owners with the current budget when it gets approved, the new master insurance certificate when that renews, any sort of meeting minutes, any sort of notification about special assessments, litigation. So all of that should be readily available to the seller. And if they don't have it, they can simply reach out to their management company who they pay their dues to, and they'll be able to request that information, and the management company will provide it.
Is it typical, Ian, that if when you're requesting documents, if there is a reserve study that's noted on the HOA cert, you guys ask for that, or is it typical that the reserve study is available to the seller if they request it as well?
Both, really and truly. A lot of the times, if there's a recent reserve study, it'll be in a resale package, but it would also be something that the seller can request because they're privy to all of the financial information of the HOA being an owner.
Ian,
Uh-huh.
can you kind of, when you request that pre-submit process, do you need the owner's okay to request the reserve study, or do you just normally ask for it? That's always such a key piece of info on the overall health of the complex.
Right. So what we do is that we're kind of talking about like going into reviewing for critical repairs. So what we do up front is on our questionnaire, we ask specific critical repair questions, which we'll go over here shortly. And then if any of them are yes, or they have an inspection or reserve study in the past 3 years, we review those inspections or reports for critical repairs. And that's kind of where that comes from. But if there aren't any critical repairs self-identified by the HOA on the questionnaire, and there is no reserve study or inspection in the past 3 years, we don't require an HOA to get one.
Okay, gotcha. Great. That's great information to have up front.
Absolutely. It's
And
going to get better.
how long does it take to get your information from the HOA typically?
Great question. So whenever we order docs, we're at the mercy of the management company and their quickest option available for us to obtain. All these management companies utilize, data acquisition companies like HomeWise or Condo Certs, or sometimes they do complete the questionnaire themselves. But with that being said, here at Movement, we order docs on the quickest rush option available for us to obtain those docs. And I would say on average, it would be anywhere from 3 to 5 business days for us to get those docs in.
Okay, great. Thank you.
You're very welcome. Okay, so now we're going to kind of touch base and go into conventional and jumbo financing. The reason why these two are commingled is because all of our jumbo products, and I've yet to see one that's different, follow Fannie Freddie condominium requirements. So everything you see in this section of the presentation also applies to jumbo condominium financing. So condo review documentation for a conventional jumbo file. We're getting a questionnaire, a budget, and the project insurance. If it's in a resort market area or it's a new project, we need those CC&Rs, bylaws, rules, and regs. If it's a new project in Florida, then a Fannie Mae level approval and review is required in order for any lender to close in there. Now, part of the new documentation that we just kind of touched base on is the structural and or mechanical inspections within the past 3 years. If there is said inspection, every lender has to document the file with that inspection and review it for critical repairs. Now, what I want to be abundantly clear is that if there is no inspection, we don't require the HOA to go out of their way to obtain it. It's just if there is one, we have to document the file. And then these are the critical repairs as defined by Fannie and Freddie that we are looking for. Things like significant material deficiencies, which if left uncorrected have the potential to contribute to critical element failure or system failure. Like there's a building envelope project, they discover water intrusion and it has a significant impact on the structural integrity of the building and immediate repairs are required. That will be a problem. Then you have things like water intrusion, potentially damaging leaks, advanced physical deterioration, any project that's currently in with their local jurisdiction for a failed inspection, like a fire marshal inspection or, a balcony inspection, things of that nature. And then the last bullet kind of goes back to the reserve study. Unfunded repairs costing more than $10,000 per unit. Now, unfunded is the key takeaway from that, and immediate repairs that need to happen within the next 12 months. So keep that in mind. Like if they have a special assessment because they're replacing all of their mailboxes, but the project's funded, that would not apply. And that's obviously not critical and not in regard to the structural integrity, safety, or habitability of the project. So we ask these questions on our questionnaire. If they're all no and they don't have an inspection, and that's no as well, then our critical repair review is done and we don't have any issues. So that's the big takeaway from this major update that has come out that we've all been dealing with, maybe even pulling our hair out a little bit about. That's what this entails, is review of inspections and reports for these defined critical repairs. Now, at this point, are there any questions about these critical repairs and the impacts that we're seeing on the market or anything like that? All right, we're going to move straight forward into full review and limited review, guys. So full review is a lender level review, and it's an approval good for 12 months on established projects, 6 months for new projects. And these approvals are for the project, not the buyer. So if you have another buyer coming in and we just approved this project, movement is going to be able to do that deal and won't have any hangups with the condominium. It's not buyer specific, it's project specific. It's called a full review, which means minimum down financing can be utilized. Our approval is exclusive to movement and no other lender is going to be able to piggyback off of our certification and close loans in there. Other lenders likely have massive overlays to the agency guidelines. So just keep in mind, just because movement has it approved doesn't mean any other lender is going to be able to go in there and approve that condo project, guys. And we'll talk a little bit about what those overlays are and what that means here shortly. Now we kind of dive into limited review and what that means. Now, limited review is only good for established projects, can't do it on new projects. It's also an approval that's good for 12 months, and it's also an approval that's specific to the project and can be transferred from one buyer or one owner for a refi to another. What's the difference between limited and full? Well, there are certain things we don't have to review for on a limited review, and these are it. The 10% reserve contribution listed on the budget, fidelity and general liability coverages, HOA dues delinquencies, not to be confused with special assessment delinquencies. And then if you're doing an investment transaction, we are not concerned with the rental ratio, the number of units in the project. You can have an investment transaction so long as they're eligible for limited review. That rental ratio of the project could be 100%.
Question.
Uh-huh.
Oh, question, Ian, on that. On the limited review, you're utilizing the same HOA cert, and so we're seeing that information, let's say on the percentage of owner occupancy to investment, but we're not utilizing that information in our review. Is that correct then?
Correct. Fannie Mae and Freddie Mac acknowledge the additional risk that comes with a limited review, which is why they require more money down. That's how the buyers qualify for the limited review. They specifically allow us to disregard those items listed that a lender no longer has to review when the loan is eligible for limited. So qualifying for a limited would be 10% down for primary and 25% down for second home and investment. So going back to the other slide, if you're doing an investment transaction and your buyer is putting down 25% or more, we just simply do not care about the rental ratio in the project at all. And I want to make it clear that it's never an issue for primary or second home transactions, even at minimum down for those occupancy types. So at this point, is there any kind of questions about full, limited, critical repairs, conventional jumbo condo financing?
I think, Ian, one other thing I think I have you point out, because you speak to it better than I would be the only other thing, and I guess I don't think of it necessarily as a review, but kind of in a way I do is looking on is in the, it's not public to everybody as it used to be, would be the Fannie Mae approved projects would be the only other difference, where it's already been reviewed by Fannie and fully approved, and it's approved for everyone.
Right. Yeah. So when it's a Fannie Mae approved project, all we have to do is obtain master insurance and confirm that the master insurance is compliant with Fannie and Freddie requirements. So that one is super easy, and you can also utilize a Fannie Mae approved project for minimum down financing, and still the only thing we have to get is the master insurance to review for compliance with the agencies.
That's all I had, Ian. Thank you.
All right. So now we're just going to kind of jump into FHA and VA condo financing. So unless a condominium is already FHA approved, a lender must gather about 15 documents and submit to HUD for when HRAP is required. The package upon receipt and receipt to HUD, it's a 4-week turn time. So HUD reviews do not happen quickly. However, in 2020, HUD came out with single unit approval. A lot of agents and loan officers still refer to it as spot approval. However, it's just not the same as the spot approval from the past, because the single unit approval still requires the same amount of documentation as a HUD package, and it's actually more restrictive, but that approval is good for a single unit. It's not a review of a single unit. The approval itself is just only good for a single unit on a single loan, and it has to be done every single time. And the benefit of the HUD single unit approval is that it cuts out that 4-week turn time. So you're taking a project review that could take anywhere from 6 to 8 weeks to gather docs and get it submitted to HUD and have HUD review. You're cutting out 4 weeks. So you're looking at 2 to 3 weeks, and it's really contingent on how knowledgeable that management company is with getting us what we need for an FHA package. Now, VA is a lot different. Instead of it being about 15 documents, it's about 7 to 8 documents. And we escalate that up digitally to VA. Their stated turn time is 4 weeks. However, we're seeing VA review as soon as 1 to 2 weeks. So we're expecting VA review decisioning from start to finish about 3 to 4 weeks. So VA is much quicker, much less documentation. And the other good thing about VA is the VA condo approval is good for life. There's no loan level review for VA, whereas HUD, their approval is only good for 3 years when it's an ATRAP. Single unit approval is only good for that one loan. And what's really different with HUD as well, even if it is FHA approved, every lender still has to do what's called a lender level review. We have to get a HUD questionnaire and we have to get the insurance. Now, that's still much quicker than the 6 to 8 weeks if it's not approved at all. But just keep in mind that if there's new litigation, excessive delinquencies, or the rental ratio is now over 65% of the project, even though it's currently FHA approved, we won't be able to close on it. So that's something to keep in mind if you're looking to go under contract and a listing agent's asking you to lift contingencies because you're going FHA and it's FHA approved. You're going to want to keep that condo contingency because every lender still has to do a lender level review. Now, at this point, any questions about FHA or VA?
Ian, this is great info. For an agent who's considering accepting an FHA single unit approval on their listing, can you talk a little bit about what, kind of what is being looked at there and then what kind of overall closing timelines you're seeing?
Right. So single unit approval, it still doesn't happen as quick as conventional. I know I was talking to Mona. She asked about like how quickly it takes us to get docs. 3 to 5 business days conventionally. For FHA VA, because it jumps from 3 to 4 docs conventionally to 15 docs for an FHA, I would say it could take up to a week and a half, 2 weeks to get all the documentation. Again, it could be much quicker. It's highly dependent on the management company and how knowledgeable they are with what we're asking for. We're getting all the legal docs, the plats and plans, last year's financials, 22's financials, balance sheets, the current budget, last year's budget, the HUD questionnaire, and then we have to review those documents. All things said and done, it's a couple hundred pages worth of docs. So whereas on a conventional file, we review in about 24 hours, FHA and VA, it's about 2 days. You got to give us 2 days to review all that documentation. Some of the hard stops I'm seeing with FHA is insufficient fidelity. The legal docs don't specifically restrict rentals of less than 30 days. And those end up just completely killing it for FHA, single unit approval. With all of that said and done from start to finish, I would say 2 to 3+ weeks. And then you have to keep in mind, Brad, we've got to order an appraisal if it's eligible, right? So 2 to 3 weeks, you can't get a case number assigned until HUD releases it because they've seen the questionnaire for SUA, single unit approval, and then you can order your appraisal. So tack on another week before you can close. So even with SUA, you're going to want to make sure you give your clients 3 to 4 weeks to close.
Can you speak, Ian, just a little bit? Is there a similar exception kind of or single unit approval for VA?
There is not.
Okay.
But the nice thing is VA is reviewing much quicker. And you mentioned exception, and I knew what you were getting at, but I can kind of pivot that into what that means for VA. Let's say we get the docs in for VA, we escalate it to VA. They get back to us in 7 business days, so a week and a half, which is quicker than the FHA 4-week turn time, but they reject it. They reject it because they didn't like that there's an HOA board approval of tenants, or they restrict the number of units that can be rentals. We have instructions that allow the veteran to reach out to that Hawk office and say, hey, I understand you rejected this condo. I want to live there anyways. And about a couple of days to a week, VA comes back to us and says, you know what? I know we rejected it. It's going to stay rejected. However, we're allowing this veteran to move in through an exception basis. And we're still able to close on that loan for the veteran. So that is pretty neat with VA. We're able to ask the veteran to reach out if they still want to live there after they confirm, receipt of the rejection. And oftentimes VA grants said exception. The only time they don't is if it's like a major structural issue.
Thank you.
You're welcome. Okay, so we've gone over conventional jumbo, FHA, and VA. Now I really want you to understand what Movement Mortgage's condo team does, not just condo pre-submit, and providing, everybody with the knowledge that they're able to inform their seller to get documentation needed. But we have a dedicated condominium team, and all we do is work on condos and the eligibility requirements. And we work on that side by side as the credit process is happening. So there is no dust settling. And we are just working side by side to make sure the process is as streamlined as possible. Again, like I mentioned, our process is up front. A lot of lenders and banks wait for the appraisal to come in before they even request a condo questionnaire, which is crazy because here at Movement, we can get documentation in quickly to the point to where we can advise on eligibility. And if it's ineligible, we're able to save the buyer some money on that appraisal report before finding out we can't do the deal. And we also review legal docs for new projects and projects engaged in active litigation. We don't just simply give it a rubber stamp of denial simply because they marked yes to litigation. Now, I kind of mentioned overlays a little bit ago, and this is what I mean by that. We operate directly to agency guidelines. Almost every lender has their own set of guides. They refer to them as all regs, but the truth is that the agencies, Fannie, Freddie, FHA, and VA, have specific allowances that they have, which allows lenders to operate either to their guidelines or they have overlays that they add to mitigate additional risk themselves. Like maybe they don't have an appetite for condominiums in resort markets. So instead of following Fannie Mae and Freddie Mac's transient housing guides, they just flat out state, hey, if it's in Myrtle Beach, if it's in Steamboat Springs, Colorado, we're just not doing the condominium. Some other examples of overlays is litigation. I kind of talked on that. A lot of lenders give it a rubber stamp of denial as soon as they get a questionnaire back and it's marked yes to litigation. But truthfully, Fannie and Freddie have specific allowances for lenders to determine that the litigation is acceptable and allowable. Things like foreclosure litigation, or the HOA is the plaintiff and they're suing a unit owner for violating the governing docs. or the HOA is suing a contractor to recoup costs for work they had to go back and fix. The work would have to be complete, but there's a lot of these situations where we're able to rescue condo deals simply because the other lender or bank didn't do their due diligence on the litigation. Another really common overlay is the percentage of rental units in the project. Some lenders have blanketed guidelines themselves that they've put in place where if more than 50% of the units are rentals, they're not doing any loan in there, whether it's primary, second home, or investment occupancy. However, Fannie and Freddie don't care about the rental ratio for primary or second home transactions in a condominium. It only comes into play on a full review for an investment transaction. That's it. And then deferred maintenance. Right now, with these new guidelines on critical repairs and special assessments, as soon as any lender or bank catches wind of ongoing work, instead of doing the due diligence to try to prove that it's routine maintenance and not a critical repair, they just kill it. But here at Movement, we're going to do everything that we can to make sure it meets Fannie Mae, Freddie Mac requirements before we just tell somebody no. Now, at this point, kind of going back to the zero overlays, we have a lot of opportunity to rescue condominium deals weekly. Not only can we rescue them and take them conventionally or FHA or VA, even though the other lender said they couldn't, if it is truly non-warrantable, we have about half a dozen in-house fixed rate delegated products for non-warrantable condominium financing. So a lot of opportunity there at Movement for us to be able to close condominium loans when other lenders are saying no.
Ian,
Yes?
on that scenario, does that require the buyer to put a greater percentage down payment if the condo is in that situation?
Are you it would depend on the situation,
Oh,
honestly.
okay. Okay.
So if we were talking about an investment transaction and the rental ratio was like 90%, we could absolutely go conventional. It would just require that 25% down. If it was
Oh,
like maybe only 20% down.
okay.
But
All
if
right.
it was something like a single entity or it was a condo tel, then it would depend on the loan parameters for our in-house non-warrantable condo programs. And they typically are anywhere from 15% down to 20% down. So very manageable as far as non-warrantable condo financing goes.
Okay. Thank you.
You're very welcome. And then another thing that we're doing, everybody is aware that inventory is low, right? So working with developers is something we take a lot of pride in because developers are building. We work directly with developers to ensure financing eligibility for conventional FHA, VA, bonds, USDA, you name it, whatever that developer is looking for, we provide guidance. I like to call it condo consultation on financing eligibility. A lot of developers pay outside third parties tens of thousands of dollars to do that. But if a developer makes Movement a preferred lender, we will offer that service at no additional cost. So, what so many agents and developers don't realize is that it really takes the three parties to get these loans closed. The developer is going to work with the brokerage to get marketing materials and get those units under contract. And then we will also work with the brokerage to get the units, to get those clients pre approved that are looking to purchase. But we'll also work simultaneously alongside with the developer to ensure financing eligibility for those clients we are getting pre-approved. Now, one of the hot things that I know is going on in Washington is these conversions of single family residence lots to condominiums. And a lot of the times they're small 2 to 4 unit condominiums. The great thing is when they're converting 2 to 4 unit condominiums or converting an SFR lot to a 2 to 4 unit condominium, we can close these conventionally, no problem. We just need the legal docs and the insurance. We're not going to need a budget. We're not going to need a questionnaire. We're not going to need to meet pre-sales. Makes it very easy. FHA is a little different, and so is VA. FHA, we are still going to have to submit for an FHA package. Same with VA. But the nice thing is we're able to get some or all of them closed readily up front with conventional or jumbo financing. And then, just kind of summarizing, we offer condo project financing for conventional FHA, VA, jumbo, USDA, non-warrantable, and several bonds. Non-warrantable condo scenarios that we do and handle in-house at fixed rate, condo tells, excessive commercial space, excessive single entities, excessive insurance deductibles, guys, mandatory memberships, and anything else that's not stated, we can escalate to the investor and they'll consider on a case-by-case scenario. So going back to those rescues, if the other lender got it right, they may have not had a program like we have at Movement to still for us to turn around and still be able to offer financing to your clients. So make sure you keep Movement in mind if you have a lender telling you no. Rescues, just ask that lender for the questionnaire, budget, and insurance that they reviewed to determine it was ineligible and send that to your Movement loan officer and we'll get it reviewed. The thing to keep in mind about that documentation is they charged the buyer. So just like that appraisal report, that buyer has every right to obtain a copy of it. So if you're the listing agent, ask the buyer's agent to step in and ask the lender for the documentation so you can see if Movement has an outlet. Or if you're the buyer's agent, go directly to the lender and ask for that information right away. Now, we kind of talked about that, but at this point, guys, are there any questions that anybody has regarding anything we've talked about at this point?
Ian, what are some of the things that you've seen come up that you can't get around? There's like no options for it, whether it be straight condo approval or non-warrantable.
Gotcha. Great question. So a lot of the issues that are hard stops across the board, construction defect litigation, where the HOA is suing the developer alleging defects project wide. That's going to be a hard stop unless everything is fixed and it's documented via post-inspection work and the HOA is suing the developer to recoup costs. But honestly, I've never seen that before, but like once, because 9 times out of 10, it's millions of dollars worth of work. The HOA is relatively new. They don't have those kinds of funds on hands to make the repair and then sue the HOA. And a lot of the times it's not recommended that way via, per the guidance of attorneys. They want to go through a discovery phase and have pictures taken and do temporary repairs. So construction defect litigation, 9 times out of 10, is a hard stop. Another thing that can be pretty ugly is major critical repairs. If the HOA is evacuated or part of the project is restricted because it's unsafe, a lot of agency or all agencies typically do not want to touch that, and not even our non-warrantable investors really want to touch that through our in-house fixed rate non-warrantable products. The only exception to that would be if it doesn't apply to our subject units building. And even then, there has to be some really strong buyer qualifications. Another scenario that I'm seeing that impacts really more so of California than it does Washington is brush fire insurance. A lot of HR, a lot of insurance companies are pulling out of California as a whole. And I know that it applies to some of like Eastern Washington where you're in a brush fire zone, but insurance has made it so expensive to obtain brush fire insurance that even if the property's worth $100 million, the project as a whole, they only have 10 million in brush fire, wildfire insurance. That's going to be a problem. Agencies and our in-house non-warrantable investors want to see sufficient coverage. They allow excessive deductibles, but they want to make sure that the collateral they are giving a loan out on is fully insured. So those are really the main hard stops there, Wendy. Construction defect lit, a major critical repairs, and insufficient insurance.
What are some of the most common non-warrantable reasons for going that direction? Maybe in Washington State.
So I'm seeing a lot now in Washington State, excessive insurance deductibles. Fannie and Freddie, specifically Fannie and Freddie. If it's already FHA approved or VA approved, it's just not an issue. But non-warrantable, excessive insurance deductibles. Let's say they have a per unit water damage deductible. That's a really common one, guys. Per unit deductible for water damage. We have to multiply that per unit deductible amount times the number of units, and it cannot exceed 5% of the property coverage amount. Seeing a lot of that go through. We have an investor that has a massive appetite for that. We have a very high success rate in regard to them approving excessive deductibles over 5%, which is the Fannie Freddie Max. So that one is very common. Another common scenario is an excessive single entity, one person owning multiple units in the project. We've got one investor that will accept up to 50% of the units being owned by one person. Fannie and Freddie's max is 20% to 25%. So we've got an investor that's willing to approve a condominium when there's a single entity that owns half of the project. Another big one is condo tells. True condo tells where the HOA is getting rental commission. There's a mandatory rental pool. They have an on-site lobby with a front desk where you check in and check out. It essentially looks and acts like a hotel, but legally it's a condominium. We see a lot of that in the coastal areas. We see a lot of that in the mountain areas. And we have 4 investors that are totally acceptable, that are totally fine with condo tells. And then I'm not sure if anybody does any snowbird deals in the Florida market, but Florida's developers back in the late 90s thought it would be great. Hey, let me hold on to this clubhouse and pool that I'm building for this HOA. I'll put that in my name and lease it back to the HOA. Fannie and Freddie have zero tolerance for that, but all of our in-house non-warrantable investors accept mandatory memberships. So those are all of the really common scenarios we're seeing, Wendy, for non-warrantable condo financing.
Any other questions, guys?
Hopefully no one's sleeping on this.
No,
Thank
thank you,
you
Ian, for your
for-
time. I
Yeah.
Yeah.
just
thank
appreciate
you.
you always picking up the phone and helping there. So
Yeah, and I'll make sure I get this slide deck to Wendy and Corey, you guys, and just reach out to them for it. And I mean, I know there's a lot of takeaway, a lot of points to take away from this and some knowledge, but please, the easiest thing to remember 9 times out of 10 is we're going to need 3 docs up front: questionnaire, budget, and insurance. If you're working with a buyer and they're interested in a condominium, hit up a movement mortgage loan officer about condo pre-submit. If you're looking into eligibility and how to list a condominium unit for your seller, empower your seller to get, the documentation that's readily available to them and get it over to your movement mortgage loan officer so we can talk about eligibility before you even list. That's it. I'm off my soapbox.
Yeah, great. Thank you, Ian. That's a great service.
You're very welcome, and let us know if you guys need anything else.
Awesome. Well, thanks, Ian. We always appreciate all of your help.
Absolutely, you guys are very welcome.
Thank you. Thanks, Wendy.
Bye, everyone.